a slightly more sensible direction. But we will be clear what we're going to do. Before I start, let me introduce the panelists. So to my right is Laura Alfaro, Warren Alpert Professor at the Harvard Business School. To her right is Mark Carney, who is now the United Nations Special Envoy for Climate Action and Finance, but has been governor of both the Bank of England and the Bank of Canada, which is, I think, unique as far as I know. I've been trying to find out whether there's anybody else who's been the head of two completely different central banks. Presumably in the ECB, there must have been some overlaps. To my left is Thomas Jordan, who's chairman of the governing board of the Swiss National Bank, which in terms of inflation performance is surely the best in the world for decades. To his left is Julio Velarde, who's governor of the Central Bank of Peru. And to his left is Catherine Garrett-Cox, chief executive officer, asset management at the Gulf International Bank. So a nice wide panel with a nice broad range of experiences. And it's pretty obvious why we will be addressing this, because we've just gone through a pretty big inflationary shock, not, to put it mildly, widely expected. And we are still in the process of getting it under control. And that has raised, obviously, lots of questions about, was this a monetary policy or other policy mistake, or was it just a series of shocks? And how does that interact? And what lessons should we learn from what has happened? We're not, I think, going to predict what's going to happen to interest rates next, because I have a strong suspicion that the only people who could tell us about that with any confidence here are not going to tell us. So one thing I've learned is, as a journalist, is you don't ask a practicing central bank governor when he or she is going to raise or lower rates. Isn't fruitful. So we'll focus mostly on that, and then we will look at, having looked at the lessons of this episode, we will then look at, probably relatively briefly, about whether, beyond what this teaches us for the operation of monetary policy, we will look at whether central banks should be given other mandates or have other objectives. And there's particular focus, and it's very appropriate in this context, the Mark is here, on the climate mandate. And should there be, or if not a mandate, how should it be taken into account? But there may be some other issues that we want to address. So let's start then with the lessons from this episode, which has been the most significant inflation episode, I would say, since the late 70s, early 80s, globally. And so, and it was certainly not expected. But of course, we had extraordinary shocks. COVID, the post-COVID recovery, two wars. So what do we learn from this episode? Is it basically nothing could have been done to prevent it? It was just one of those things, and they're doing a magnificent job of bringing it under control? Or actually, were there some serious policy mistakes we should be thinking about? What do you think, Thomas Jordan?
Well, I think the policy regimes or the policy frameworks are okay, they are good. It was probably more a difficulty to make the right analysis. So what was permanent, what was transitory? I think there was a certain mistake at the beginning. Our monetary policy framework served us quite well. We could react relatively early and could maintain inflation at a very low level. Now, looking forward, I believe what is really important is having a forward-looking approach, not looking at the actual inflation, really having a forward-looking approach. Low inflation is not really bad. It's much better than having high inflation. I think we have also to be humble about our capability to forecast. So we have to review these forecasts all the time, take into account also structural changes. And in my view, what is very important to have a risk management approach. So I think it's much better to take decisions that are robust for a wider variety of different outcomes, rather than to choose one particular policy that may be the best, but only in one particular scenario. So I think risk management approach in the future is very important to focus on price stability and not to go into, let's say, extreme optimism, optimization for monetary policy.
Can I just follow up with one question which many will ask, and very interested in your views, is you said, which is what I would expect you in particular, the Swiss National Bank, to say, low inflation is not really too bad. Do you, one of the critiques people would make is that before the shock, in the teens, a number of major central banks, notably the Fed, but also the Bank of England and the ECB, worked very, very hard. And now the Japanese Bank of Japan is working even harder to get inflation up because they do think it's bad. And in the process, they did enormous monetary expansion, at least expansion of the monetary base. Do you think that was a mistake?
Well, I cannot really speak for the others, but in our case, I think it was extremely helpful to have a more flexible approach, that you can say everything that is below 2% but positive is an acceptable level. So we did not have to go into extreme monetary policy decisions. So sometimes it's extremely difficult to bring inflation from 1 point to 2% points, and everything else is functioning very well. So I think we can maintain normal monetary policy even if inflation is for some time below 2%.
But above zero?
Yeah, of course, yeah.
Yes,
yeah.
okay.
It has to be,
So, and that, of course, was the problem for the Japan, which we must be clear about. Julio, if I may address you so, what is your view of the lessons of this experience and why it happened and what we should learn from it?
Well, first, probably one lesson is that there was overconfidence that inflation has been conquered. The accumulation of the 90s and the effects of the Lehman crisis made inflation very low, and even this worry that we were mentioning about the ECB, Bank of England, the Fed. I also believe there was a supply shock, but it has disappeared. There was also too expansionary fiscal policy, but also monetary policy was too expansionary, and the effects were not so visible at first. In a case, we started increasing interest rate from 0.25, we increased in August 2021, as soon as inflation was exceeding our target. But even at the time, when Powell was saying, the same man when Powell was saying it was transitory, even at that time, we were not so sure that it was going to last a long time. Even the first 2 months of 2022, before the invasion of Ukraine, inflation was a little more than 2% annually. So it seemed that it was just an episode that you should just normalize the monetary interest rate, and then happen in Ukraine. With this so much liquidity in the system, you couldn't fight this increase in prices so rapidly. We have increased the interest rate all the months until January of 2022, and we have started reduction of interest rate in September, five reductions already in September last year. But I believe that it's very, you knew it was a supply shock in a great measure. You cannot apply a strong monetary brakes because we look at a recession. So the only way was increasing your interest rate month after month, trying to stop this, no? And now I believe that inflation is on its way back around the world. And probably we are going to get there. Some countries might reach in 2025. In our case, our core is now within the target. And we expect headline to be within the target in the next 2 months. So we are pretty well. But it is a process, and I believe it has to do something with what Thomas was insinuating in part, credibility of the central banks. That you are going to react and inflation is going to be higher. It's not only the effect on the interest rate on demand, it's the credibility that the central bank will continue pushing rates until inflation is controlled. So I believe that affects in part the reaction of the markets, no?
So let me make sure I get the numbers right. You said you've had 5 reductions in interest rates?
Yeah, starting September. Actually, just to finish, we were the first country in the world to start inflation targeting with negative inflation in 2001. The second was Japan with Corona in 2014. No? So we had episodes of very low inflation, but we are not Switzerland, of course.
And when did you first raise rates?
September of last year. This is we have monthly meetings. So the last increase was this month.
I'm a little bit puzzled.
No, when we reduce increase, excuse me.
No. You've been, if I understand it, you've lowered them 5 times since last September. When, before that, did you first increase them?
August 2021.
So you were ahead of, as you said, you were ahead of all the major Western banks by many months.
I believe Latin America and Eastern Europe were the first to hike, no?
Okay, that's very, very helpful, just so the audience understands this clearly. Laura.
So first, let me clarify, I'm not a central banker, and I want...
You are married to a former central banker.
Yes.
Yeah.
Thus, I want to be humble, because as they say in Latin America, it's not the same to see her coming than to dance with her. No es lo mismo verla venir que bailar con ella. Meaning, it is very easy for me outside to be more critical. And let me take perhaps a more academic view. I think we're going to go back and we're going to see big shocks. And we're going to say, yes, government spending had to go up. We will disagree on the quantity, not on the direction. I do think there was a little bit more than was needed, especially in certain countries. Then we needed monetary policy. Some countries saw the concerns early because they saw the effects early, but also they were more sensitive to the effects. To your point, in Latin America, we have it very clear. Inflation is a very regressive tax. In Latin America, our history of income inequality and poverty is also a history of very high inflation. And thus, I think that is why many countries in Latin America, at the early signs, acted, because it's our poor people, the one who pay inflation. Exposed, it's interesting that we have seen a very quick reduction in many countries. I don't think we're going to take it as the regime didn't work. As of right now, if you try to explain the reduction in inflation on the usual suspects, inflation expectations which have been anchored, labor supply and disruptions in supply chain, we probably won't be able to explain it. That means there was some productivity change. And again, it's possible that it's AI, although I don't think we see the effects just yet. It's possible it's some home work, Zoom, logistics. But I think exposed is going to look a lot like the 90s, that we managed to bring it down very quickly because of some productivity that is hard to measure. In the 90s, it was computers, Walmart logistics. Now it's going to be some mixture of Zoom, AI, logistics. But I think exposed, we're going to see it worked. There were some deviations we cannot explain, but on average, the regime worked.
And are you, when you say that, you're thinking that specifically in the Latin American context or more broadly?
I think more broadly, people would say some acted first, some acted later. Maybe they should have acted early on. But I think in hindsight, we're going to say the tools worked.
Okay. And I think you've stressed one very important point, which actually surprised me a bit, which is inflation expectations seem to have remained rather well anchored. I actually have to say that I find that very surprising because it's a huge price level shock. But it does seem to be incredibly important, and it is a very significant issue. So let me now turn to you, Catherine. How does the private sector feel about this mess? Sorry, this transitory shock.
Well, thank you very much, Martin. Well, yes, I'm always rather nervous of being on a panel with Mark. And I'm very glad that you started off by suggesting we don't get into the topic of short-term interest rates, because I think my perspective is that we've got to dispense with the obsession of the short term. And the reality is that, the short-term framing around topics such as this is distinctly unhelpful for what we need to tackle in the world today. And as we all know, monetary policy is also an imperfect tool. So the perspective that the private sector brings to this is mostly what we want to see is a resilient financial system. And there is no doubt that the short-term obsession with some of these topics is at, frankly, complete odds with the long-term investments that we have to make in areas of whether it's climate change, the whole transition that we need to see in the energy space, and more and more. And I think we'll probably come back to that in the second part of your panel. But I also think that one of the lessons that we've learned through this whole cycle, Martin, is that organizations need to be much better at stress testing. Yes, in part, that was a mandate from the central banks, and that has been helpful. But as a long-term investor, one of the things that we're really looking at is have organizations embedded more robust scenario analysis, stress testing into their corporate DNAs, because ultimately they will then be much more successful in the long term. So I think, as I said, the private sector, generally speaking, likes to invest on a long-term basis. And when you think about some of the challenges that we're tackling today, whether it's healthcare, whether it's the climate space, everything that's going on in AI, one of the things that gives me great hope is that in a post-pandemic environment, we've learned to move faster. One of the conversations we sort of had sort of previously is, do we return to a pre-COVID environment? And personally, I really hope we don't. Because if you think about the transformative things that we've got much better and faster at since, collaboration, generative AI, really tackling some of the big issues in the world, I think you have to be full of hope, but I reiterate that we've got to focus on the long term.
Do you think, just a little wrinkle on that, and I've been thinking about this, you talked about stress testing and stress testing yourself as a business, not impose. It would seem very, and I'd be interested in what's happening. All these shocks of the last few years, alongside the financial crisis itself, would it seem to me have automatically forced business leaders to consider the risks and therefore to stress test themselves. Whether that makes them more long-term, I'm not clear, but it might make them much more aware of the environment in which they might be operating. Do you think that's true?
I think it is true. I mean, obviously, I represent a bank and asset management business, so I would say categorically in our case. I mean, we were doing much of this before the bank, the central banks mandated this. But, ultimately, it creates more resilience. And it forces us to really understand what is happening in the macro context. And frankly, it's not just climate change that's causing shocks in the system. We have geopolitics. We have conflicts everywhere. We have an uncertain political, situation over the next 2 years. So I think if you don't come back to where you started, if you don't deploy effective risk management across your business, you are missing a major trick.
So, Mark, what is your assessment of the transitory blip stroke colossal mistake? What do we take away from it, above all, in terms of what we must continue to do and what we need to change?
Okay. Well, first, it's a pleasure to be with all of you, Catherine especially. I guess I'll put it in maybe the following framing, which is that for a long period up until, including post-financial crisis, really up until the COVID shock, most central banks, not all, but most central banks, certainly in the G7, were operating in a world of what's called divine coincidence, at least in central bank parlance. In other words, inflation was below target, and their economies were operating below potential. So to the extent to which they thought about a dual mandate, either formally in the US or getting the economy back to potential as a means to have inflation at target, both sides said one thing: stimulate. And the question was calibrating that stimulus and making sure that it was in the right direction. Okay. That is not the case when you have a supply shock. When you have a supply shock, as has been painfully demonstrated, you have to make trade-offs. And if you're an inflation targeter, you have to decide, to the extent you can as a central bank, and there's limits to your power, of course, the horizon over which you try to bring inflation back to target. That's the flexibility in inflation targeting. If it's a one-off oil price shock, for example, you look through it. but central banks were not faced with one-off supply shocks. They were faced with, like London buses, a series of supply shocks that showed up at the same time. And I very much re-emphasize one of the points that Julio made, and the Ukraine shock on the energy side and the knock-on effect of that on top of existing shocks that are coming out of COVID are significant. Now, we had this theoretical experience, or more than theoretical experience, at the Bank of England when we looked at Brexit. And this is in the public record because our scenario analysis was pulled out from us by Parliament. We viewed that it was a supply shock, which it has proved to be. And the consequence of that would be the economy would slow, the exchange rate would go down, inflation would go up, and the Bank of England would have to tighten interest rates. And that's exactly what happened. At the time that was released, apart from my central banking colleagues in private, nobody, I shouldn't say nobody, very few people recognized that as a credible scenario. That's how long the world had gone, you referenced the 70s, without a major supply shock that had some endurance. Next point, and I'll finish up, which is, so how has inflation come down? It's come down, and it hasn't come down, if I may, the job is not complete. Nobody's suggesting that it's complete, but progress has been made. And it's come down for two broad reasons. One, part of those supply shocks have unwound, particularly with respect to, obviously, COVID-induced issues with supply chains, challenges in the goods market, some recovery in labor markets as people have themselves gone back into the labor market. The energy price shock, of course, it can reemerge, but flows through. And then, crucially, the actions of the central banks enacting to tighten have moderated demand, such that there's a greater prospect of demand and supply being in balance. So that's the overall aspect. And the last point I'd just make is that the lesson I would take from this is the strength of the regime. Sure. There's issues of execution and the degree of difficulty that my peers, former peers, I guess, have had to deal with. But the strength of the regime, flexibility, crucial importance, point Catherine made, of macroprudential, of having a resilient financial system so the financial system itself can deal with these shocks. And I think you have to give very high marks to the central banks and other authorities because the system made it through those shocks. But the last point is that we are in a world, I would suggest, where we're going to see additional supply shocks with some relatively high degree of certainty, with some persistence. And just to finish on that, which is, effectively the world is being rewired. Our trade routes are being rewired through de-risking of supply chains. That is a form of a supply shock. It will have some persistence. Obviously, energy systems are being rewired with addressing climate change. And so those are both, for a period, have some headwinds, ultimately could bring greater resilience, and moving in the other direction, and I think it's very early days, so I don't think it's showing up in supply today, but we have the rewiring of intelligence and the positive supply shock that will come, I suspect, and others here in Davos are better placed to comment on this and affect it. I suspect we don't start to see that until later in this decade, but then central banks will be grappling with headwinds and tailwinds, if you will, on supply, on top of their usual responsibilities of managing demand and a resilient financial system.
Just ask one follow-up question of the two central bankers, others may intervene. Just before the crisis, a number of central banks, not I think the Bank of England, but certainly the Fed and the ECB, were indicating or explicitly shifting their regime in a way to be more backward-looking. In other words, to say that if we have failed to hit the target for a long time, that means we're not where we should be cumulatively. And in that situation, we ought to wait longer to react. And we're committing ourselves to wait longer to react. And they sort of announced this pretty well, my memory is 2019. I may have got the...
let's say thereabouts, but just in the run into the timing wasn't optimal.
The timing was not.
Let's put it.
Do you think that way of looking at things was one of the reasons they didn't recognize that if you've got a significant supply shock, well, that sort of means you're likely to have excess demand? Right, as you pointed out. And therefore, you should start thinking about what that means for your monetary policy.
I think it's fair to say, with the full wisdom of hindsight, that the Fed felt its hands were tied for a longer period of time because of that regime, the flexible average inflation targeting regime, and that they had added to that regime a series of other conditions that in terms of sequencing of the changing in policy as well, and actually specific outcomes in the labor market above and beyond just the level of nominal GDP that meant that they waited too long. And I think they would, well, I won't.
What do you think about this? I mean, in a way, it seems to me one of the big lessons of this is you have to be consistently forward-looking. And that I think consistent very much with what you said at the beginning. Is that one of the important conclusions?
Well, for me, yes. I think forward-looking is absolutely necessary. Although I think the very difficulty was, given these supply shocks and the war, the disentangling between what is permanent and what is transitory. And there the views were very different at the beginning. And that was maybe independent of whether it was forward-looking or backward-looking. But in general, I said at the beginning, I think it's very necessary to be forward-looking. But Mark said it before, the uncertainty about what happens in the future is also very big. So we have always to review our forecasts and then to adjust again. So the uncertainty is very big, and we have to find a way to make robust decisions within this very uncertain environment.
Would you add anything on that?
Yes, I believe it has to be forward-looking, but the vision of the future is tinted by what you have seen in the past. That non-existence of shocks since the 70s, the low inflation for almost 30 years. Even what we saw before Lehman, the confidence in many policymakers in the States that that cycle was conquered, that there was not going to be a recession. So it's true, you have to be forward-looking, but your forward-looking vision is affected by what has been happening in the recent years. No?
Can I perhaps think? I've been thinking about one final question, then we'll go on. But then want to go particularly to some of these other issues. But we essentially decided that after the financial crisis, that we needed to change our whole approach to financial regulation in a pretty big way. It was a big failure. What I'm hearing here is the view that, yes, it was an inflationary upsurge because of unexpected supply shocks. There were some parts of the way they were approaching their mandate before, which was probably a bit too backward looking. But the essence of the regime, what turned out to continue to be relatively flexible labour markets, that's quite important. That's other policies. The inflation expectations reigned quite remarkably well anchored, despite a big shock. It looks as though we have a very good chance of getting out of it, though we don't know how quickly. That actually we can say that after this shock, unlike the financial shock, there isn't actually any real need to change the way central banks handle monetary policy. Is that your view?
Again, there's a lot of heterogeneity and a lot of regimes. I once was in a meeting where an important policy maker was saying, "Oh, the problems with deflation." And this was a speech that was given in Brazil. And everyone in Brazil was like, deflation. So again, some of these views
that... very short memories.
Some of these views of we had problems with getting inflation up and were more of the North than many other countries. I think that probably helped them in thinking, well, we need to react. But in terms of the tools, I think in hindsight, we will say the regime worked. I am a fan of inflation targeting because it does give you flexibility. You don't need to get the target today. You can get it in. And I think that worked. And so going to these grand visions of changing monetary policy, I actually don't think we need them. I think getting inflation right is not easy. Getting whether it's a permanent, transitory, is a supply shock or demand shock is not easy. I think getting inflation to the right number is extremely important. Again, I think some of the deviations is not everyone thinks how regressive it can be. I think many countries...
Clearly, you can see it in the politics.
Exactly. I'm of the view, the poor people pay it, so we shouldn't deviate from a 2% target and so on. And thus, I would maintain it. Like, it's not easy to get the number right. Let's not complicate it, and let's try to work towards getting the number right.
So one final little thing here, I think, and then I want to go into these other issues. But Thomas said, which I thought was pretty important, that you should be pretty relaxed between 0 and 2, which means, by implication, that you might be at 0 and be relaxed about it, and then, of course, it might suddenly be negative. Would you take the same view about, and this is a really big controversy now, as you know, lots of people, I've spent years fighting them, say, well, when it went down to, less in Britain actually than elsewhere, but when it went well below target for long periods, the effort to push it up with all that it meant, QE noise, was just a huge mistake and a huge distortion, and we're suffering from that in part, if not in the inflation, at least in excess debt and all the rest of it. So Thomas is right. This is what we should have done.
Well, first thing, it's always good to look at the numbers, and inflation averaged just under 2% in the UK.
Not in the UK.
Yeah, so if I could speak for
the UK actually hit its target.
Yes, thank you. Thank you. Can we memorialize that? This is
we're better at inflation than some countries.
We're okay at inflation. We just got it under control. What's critical in it? Look, yes, the flexibility should be used on both sides. First point. Particularly if you have situations where you have good disinflation. In other words, you have, let's pretend we're in 2028, 2029, we're all invited back and we're here, and we have this productivity dividend that's coming from AI and from the net zero transition, which does give a productivity dividend as it flows through. And then we have lower price inflation. There is a pretty good, and we should be having a pretty robust debate at that point about taking some of that in lower inflation, that supply benefit, stretch it, using the flexibility to take longer to come back, and making sure that we have robust, and regardless of whether we do that, I would say one of the lessons of the productivity boom in the early 2000s and the response to that is that might have been a better policy and
more in the late 90s.
in the U.S. late 90s in the run-up to the what turned out to be the run-up to the subprime crisis. But we can have a broader discussion. We don't have time for. And then the second point I just want to emphasize, though, is that it is, and it picks up on something Catherine and actually everyone has touched on, is I think the regimes that will perform better in the next few years are the ones that were very robust during the pre-COVID period on the health of their financial systems and thinking about their mortgage markets and thinking about indebtedness. And so those who put in place basically restrictions so that you couldn't take out a mortgage, even though bank rate was 1%, unless you could service it at 5 or 6%. Those types of macroprudential measures, which weren't hugely popular, but now are incredibly relevant. And that means the system, the financial system functions better. Last point, if I may, which is that this thing on stress testing, it's very hard to stress for the crisis that actually happens. Sure. You know, plans are useless, but planning is essential, that Eisenhower line. But planning for failure makes the financial institution more robust for what does actually happen. And that's why there's huge value to this in good times for the bad.
Let's just talk briefly about the mandate. I don't think we're going to get time to go to questions from the audience. I apologise, but I think that was inevitable. So I'll start with you, Catherine. If you were in charge, Chancellor of the Exchequer in the case, you could change the mandate of the Bank of England without any difference. It doesn't need any legislation or any of that messy stuff. So would you add in climate or some other considerations as a mandate, and if not, how would you incorporate it in risk management in the bank, in the bank, in its financial sector management? What do you think?
Well, I don't envy their task for a start, and we obviously have some far more qualified people on the panel. But what I would say is that I'm full of hope that across the financial service sector and actually across the economy as a whole, there is far greater awareness of sustainability factors in planning for the future. And we obviously had a huge lead globally taken by the Bank of England, under Mark's leadership. And it wasn't just a good idea, people are actually doing it. Yeah. The other hat I wear, in addition to my GIB hat, is I also chair CDP, which is the Carbon Disclosure Project, through which organisations around the world disclose their climate-related financial disclosures. And the really important thing is that the numbers are rising exponentially. So it isn't something that people are necessarily doing just because they're told to, because it makes a difference in terms of how their investors perceive the value of that organisation. So it then becomes a really, self-fulfilling circle. But I think, the second point I would make, and then sort of obviously make time for others, is that I don't think it's just the mandate of central banks to tackle climate change. I think that's far too naive. I think it is the role of governments. I think it's the role of the private sector. And frankly, it's also the role of consumers. I think if we're not aware, if we're not having these conversations with our children, again, I think we're living in a cave. And there are huge issues to tackle. If you simply look at some of the climate-related disclosures that we see through TCFD, financial institutions are holding around $9 trillion of fossil fuel assets on their balance sheets. We are going to have a big stranded asset problem, and we will need to work through this. So if we don't do it together and come back to the earlier point I made around this sort of in the eye of the storm and the pandemic and post-pandemic view of cooperation and collaboration, I just don't think we have a hope. But I am full of hope because I think we can do it.
But the key point you're making here is this is a systems problem, and it's not a central bank problem as such. It has to look at this, but it's not the main actor. Sometimes, every so often, people seem to believe that somehow because it's got all this money and monetary power, and you don't actually have to legislate anything, it just can fix it. And I think it's helpful to understand that it can't. Do you have any views on changings of the mandate of the central bank? This is one, but the other one that is much discussed, and I know you have about 40 seconds for this, is should we raise the inflation target?
No.
Okay, that's simple. Beautiful.
But also, let me add something. I think sometimes we forget we're here an elite. There's some people that do not know what they're going to eat tomorrow.
Of course.
And so for them, the discussion with their kids, I honestly think it should be, what am I going to feed you tomorrow? Am I going to send you to school? And sometimes we take that for granted. Maybe they're not the ones who should be thinking about these grand topics. And I just say it because, again, I do think we have a bias here, and we forget that there are many people that is, what am I going to feed my kid tomorrow? And that is their priority. And thus, again, inflation is very regressive, and so we want to get it right. Climate affects prices, and many central banks have already incorporated that. The Brazilian central bank does consider what is going to be the effect of El Niño, La Niña, on agriculture and price. So it's already there, because it is affecting the final price, and I think that's the way to do it and not directly.
Beautifully pointed. Julio, the mandates are perfect, or should we change them?
No, I really think that most of the emerging market countries inflation target have probably a range, in the ways 1 to 3. First, weather factor will affect volatility. So, particularly poor countries where the weight of food is higher in the CPI,
Yeah.
We have more volatility. But also probably, although you will have benefits at the end in the transition, probably there will be a pressure on prices, as you insinuated, Laura, no? So probably part of inflation might be somewhat higher than your target for some time. And it's good not to put a pressure to that, but I said that for a time will be 2.3, 2.4, 2.5, no? And not be obsessed with the number. What people want is lower stable inflation. They don't know, they don't care if there's 2.2 or 2.1 or 2, no?
Mark, what do you think about the mandate?
Well, I wouldn't change the target, so I agree with the professor. I think it's served well, first point. Secondly, I think the principal role of central banks with respect to climate is with respect to the resilience of individual financial institutions and the system as a whole. And if I could put it this way, normally what you're doing...
And this is a financial regulation.
It's a financial regulatory, yeah. And so there's
policy.
many central banks that don't actually have a financial regulatory responsibility, therefore it doesn't fall for them. You know, in general, in financial stability, this is my last point, which is you need to plan for failure. Right, so you think of, you know, there's a COVID shock, there's, you know, some bad thing happens, a big financial institution fails, so I plan for failure, think about how we keep the system functioning so those who are least well off are not hurt. It is unforgivable to have the problems of the financial system fall on the most vulnerable in society. With respect to climate, one of the key things you're planning for in stress testing is success. Society decides in the UK, in Canada, many other places, but in UK and Canada, it's the law of the land to get to net zero by 2050. So the question that's asked is, well, what if we actually do that? What if companies change their energy mix, they get their emissions down? What's your exposure? Where are your problems on your balance sheet? Where are your assets on your balance sheet? How does that move? Have you thought it through? And that's a critical aspect that just helps to support the smoothing of that transition, whatever society actually implements.
Last word for you.
Well,
on the mandate.
I'm convinced that it's very important to maintain a very narrow mandate. We can only justify central bank independence by having a narrow mandate, price stability, supporting the economy. And central bank independence is really a key success factor for a monetary policy. It's also important to see that we do not really have effective and efficient instrument to tackle climate change. So our main contribution is really a stable economic environment, and then Parliament and government can take their responsibility and take the appropriate measure. So I think a narrow mandate is really, I think, for everybody the best we can have, and we can justify independence.
Thank you very much. Well, I have 18 seconds to sum up. And it actually seems fairly clear, which in a way is almost disappointing. People agree so much. But the basic conclusion here is the flexible inflation targeting framework, which has become the norm, has worked reasonably well despite some really big shocks. And they're all going to have to go back and look at whether they did the forecasting properly and all the rest of it and learn from it. But inflation expectations were well anchored. We haven't needed apparently the huge increases in unemployment that, for instance, my friend Larry Summers thought would be necessary. That's an enormous policy achievement, which I hadn't expected. There's a good chance that we will get back onto target. In the next year or two. It's going to be pretty difficult to exit from policy. We didn't go into that, but that's clearly true. And the world is massively uncertain, and we've just been reminded of that. To some degree, the central bankers, well, not basically, they couldn't have avoided this. And we should preserve them as well as basically the regime as firmly and as well as we can. But of course, there are huge other economic and social problems, and the central banks have to play a part in this. And the most obvious way they play a part in this is making sure that the financial risks associated with them are fully internalized within the system. And otherwise, I'm afraid the solutions will lie in the hands of politics and private business and us all. I think that's very much the sense, and the hope that somehow we can hand it over to the central banks to fix is a delusion. And there are a few people who do actually seem to think that. I think they've done a wonderful job, and it's been a very enjoyable discussion. I'm sorry there wasn't time for Q&A, but
Such is life.
with 5 panelists and 45 minutes, it was never going to happen. Thank you very much.
Thank you.